Okay, guys, so let's go ahead and take a look at this example here. And this is that in class chapter 4 example that is going to be sort of like that thing that we did for chapter 2, I think, where we had an in-class example and then we sat there and we just leveraged off of that for much of the material that we understood for the first few chapters. Okay, and this one's not going to be applicable to several chapters, but it is going to be applicable to chapter 4. This is going to be the one that's going to sort of set the groundwork, and then all we're going to do is add on some things from the slides, and that's going to be the basis of the chapter 4 questions on the midterm. Yes, sir, on the next midterm. I didn't bring any extra copies, sorry. So you're going to have to, maybe you can look on with somebody or look off your laptop if you have it on your laptop. I didn't bring extra copies. I handed them out last time, didn't I? No? Okay, well, anyway. Huh? We didn't start it, but I think I handed it out, didn't I? I thought I handed it out. Anyway, well, I'm not obligated to hand it out. I put it on the on Canvas, so you should have got it there. Okay, but let's just go through this. It's a little hard to follow off the screen, but I am recording this. You can follow through with it and watch it again when you have the actual document in front of you to reinforce anything. But we're going to go slowly through it. I don't care if we do anything else today. If we get through this, that's the main thing that we want to accomplish here. Okay, so we take a look, and I'm just going to go ahead and put this in tablet mode. And you can see that we have this company starting business in this example, and they start business by doing what? By getting $294,000 in common stock. So they credit the common stock, they debit the cash, and you can see that when we do that, let me go ahead and see if I can get my pens working here. When we do that, we go ahead and what? We post the debit to cash. We post the credit to my common stock, right? And that's pretty much all that's going to happen with common stock in this. The only reason I put this in here for common stock, we already learned this in the first few chapters, is because I don't want to deal with this business with no cash as we go through and look at these transactions. So we're done with the common stock now, okay? All right, but we're going to see that cash is going to move around as we go ahead and do some different things. So we want to sell some inventory, and before we can sell any inventory, we have to purchase the inventory. So the guy tells us that he's going to sell us $310,000 of inventory. We agree to buy $310,000 of inventory, but then we turn around and the guy tells us, by the way, you know, I'll give you a discount if you pay me a little early. If you pay me 10 days instead of 30 days, I'll give you a 2% discount. Okay? Now, when we see that, how do I know that? I know that by reading these terms right here. This is saying that we will get a 2% discount if we pay in 10 days. If we don't pay in 10 days, we have to pay the whole amount in how many days? In 30 days. That is read 210 net 30. 210 net 30. 210 net 30 means a 2% discount if I pay him within what? 10 days. If I don't pay him with 10 days, I have to pay the whole amount in. You can give me 30? 30 days, okay. All right, now what happens? You look at this and you go, oh, this is a nerdy accounting thing, right? Meanwhile, wars have been fought over these terms, 210 net 30. Say, how come that deal isn't done yet? We're still negotiating over the terms of the 210 net 30, blah, blah. I mean, it's a big deal in business because this is how we are going to manage our cash, right? Okay, they want their cash a little sooner. We're willing to give up our cash a little sooner if we get a discount on it, right? So it's a big deal in business as to how you come up with these terms. Here we've got 210 net 30. Okay, so we go ahead, and since we don't know if we're going to take the discount or not yet, we set this up to debit the inventory for the full $310,000, credit the account payable. Now, we are using the perpetual method for inventory. Perpetual method says we will go ahead and debit our inventory account every time we purchase an item of inventory. Is inventory an asset? Do you increase an asset by debiting it? Okay, that's what we're doing, right? Debit inventory, and we have to pay the guy later, so we go ahead and we credit the accounts payable for 310. We post that. We're showing that we owe the guy 310,000 now, right? So we have an asset, we have a liability. With me so far? Yep. Okay. Okay, good. Then what? Then the inventory, we get around to finally inspecting it and looking at it, and we say, hey, we didn't order this. We ordered white chairs, not black chairs. What are we going to do with them? We're going to send them back, aren't we? Didn't we order white? I thought you ordered white. We don't want any more of these black ones. We have enough of these, right? So we're going to send them back, right? So if we're going to send back the inventory, do we still owe the guy the $10,000 for that inventory? No, we don't. So what do? We go ahead and we debit the account payable for $10,000. And when we debit it, now it's showing that I only owe him $300,000 because I'm sending that stuff back, right? And since I'm sending that stuff back, it's not going to be in my inventory anymore. So I go ahead and I do what? I credit my inventory, and now the inventory balance is showing the amount that I have kept, $300,000 worth, right? So I sent that back to him. Okay. Okay, good. So how much money do I owe this guy now? I owe this guy $300,000, don't I? Okay. So what happens? Then I go ahead and I pay within the discount period. And when I pay within the discount period is what? 210 net 30, so I'm going to get a 2% discount. So if I'm supposed to pay the guy $300,000 and I'm going to take a 2% discount, I'm going to get to save $6,000 on this deal, right? Because I'm going to only pay him 98%, or I'm going to take a 2% discount of $6,000. So when I take that discount, look what happens. Of course, I'm going to only credit cash for what? For $294,000, because I don't have to pay him the full $300,000. I got a $6,000 discount, right? So I credit the cash for $294,000. Notice all my cash is gone now. That's all right. I can still survive. Then what? I'm going to debit the account payable for the full $300,000 because the guy said, hey, if you pay me $294,000 today, you don't have to pay me the full $300,000. And if the guy said that, then I go ahead and I say, okay, fine. So I debit the account payable for the full $300,000 because I don't have to pay him $300,000 anymore, right? I'm liquidating that bill. It's just fine, no problem. I got you. Don't worry about it. Don't send me any more money, right? So I'm good on that. And so what do? I have to credit something. I already credited cash for $294,000. I have to credit something. What do I credit? I credit my inventory for this $6,000. I credit inventory for $6,000 because that inventory didn't cost me $300,000. It only cost me what? $294,000. Isn't that what it's showing there right now? $294,000. Don't you love accounting? Look at that. Isn't that beautiful? It worked it all out. It says, hey, you spent cash at $294,000, you got inventory at $294,000. Isn't that wonderful? Yes, sir.
So don't you still have $6,000 worth of inventory that you got discounted basically?
No, I bought $310,000 worth. I sent back 10, so I was showing it that it was worth 3. And then I went ahead and I sent the guy only $294,000, so I didn't pay the full $300,000 for that, right? What I carry in my inventory is what I paid for it. Unless the value starts to drop on the market, which is going to be lower cost or market valuation of inventory, we're not there yet. At this point, we're just going to say that we carry the inventory of what we paid for it. What do we pay for it? $294. What's it being valued at? Beautiful. Okay. We're going to see that later on we'll have to continue to watch if the inventory is going down on the market. And if it's going down under rule of conservatism, we have to write it down some more. But we're not there yet. Don't worry about that yet. Okay? Yes, sir. Yes. No, I'm done. He said, no problem. That's fine. Don't send me any more money. We're good. If I have to pay him $300,000, I'm going to wait the 30 days. Why should I let this chump float with my cash for 20, what is it? For 20 days. How many days? 10 days I paid him early? No. If you pay somebody early, you don't have to pay them as much. Right? Now, don't try this at Macy's. Don't go over to Macy's and say, hey, if I give you, the cash now, will you give me a discount? Okay, because it doesn't, they won't do it. But in sort of general, of course, maybe they will. You never know, right? But in normal business terms, where the presumption is you're buying bulk, you're buying it for retail purposes, that you're going to go ahead and use it in your business, etc., they'll give you a discount if you pay them early. Why are they willing to do that? To get their cash, yeah, right? I mean, if I said to you, hey, do you want $300,000 now or later? What are you going to say? Now, and then I'm going to say, how about if I give you $294? And depending on how that term relates to what's going on with interest rates and stuff, you may say, sure, great, I'll do that. Okay? Okay, so we go ahead and we paid $294,000 for that inventory. Then what? Well, when we buy inventory, then we're going to sell it, aren't we? Aren't we going to sell inventory?
Yes.
Right? So when we sell it on account for $160,000, but the inventory's cost is $100,000. Why did we sell it for more than our cost?
To make a profit.
Because I got to buy a Porsche, man. I mean, I got to be looking good running down the street or whatever. I need a new house, whatever, right? We want to make a profit here, don't we? Okay? So what do? We go ahead and we debit the accounts receivable for $160,000, and we credit and when we're dealing with selling of merchandise, guys, we typically call it sales. We call it sales. If it's a service, we typically call it what? Revenue. They are synonymous terms, though, right? Think of sales as our revenue. Okay, so we go ahead and we credit sales, and we have an account receivable of $160,000, right? And notice we offer discount terms. We tell our customer, hey, if you pay us in 10 days, you can get a 2% discount. Otherwise, pay us the whole amount in 30 days. What used to bother me when I was first studying accounting is, why do they call it net 30 if you have to pay the whole amount in 30 days? And that's when the teacher would say, give that kid a special class, get him out of here. There is no answer to that question, okay? I don't know. No one's ever been able to answer that, why they say net 30 when it's the whole amount that has to be paid in 30. Shouldn't it be 210 gross 30? I don't know why they call it net 30. They should call it gross 30. Okay? All right. So anyway, we set up the same terms. We debit the accounts receivable. We credit the sales. And when we debit the accounts receivable, where'd my accounts receivable go over here? I've written all over it now. Let me erase some of this ugliness on accounts receivable. Okay, and so what's happening? I go ahead and I have debited my accounts receivable, and I'm going to erase it just to put it back. There's my debit to accounts receivable, $160,000, right?
Yeah.
Right, and so for a second the balance is $160,000. Don't worry about that credit yet. So it's $160,000. I go ahead and I credit the sales. See if I can get over there without messing everything up. I credit the sales $160,000, right? Right?
Yeah.
Okay. Okay, good. So now what happens? Well, now I have to recognize the cost of those items that I sold. And so I said that this items cost me $100,000, so I'm going to go ahead and debit cost of goods sold $100,000 and credit the inventory $100,000 because I'm sending my inventory to that guy that just purchased it, right?
Yeah.
Okay, and I debit this account called, very descriptive, cost of goods sold. What is the cost of the goods that I sold? I debit that to cost of goods sold. Isn't that the most beautiful account name you've ever heard of? Because it tells you exactly what it is. Okay, so I debit that to cost of goods sold. There's my debit to cost of goods sold of $100,000. There's my what? Credit to my inventory of $100,000 because I'm getting rid of that stuff, right? And so there's that credit that's to my inventory account because I'm getting rid of that stuff. That's a credit to inventory. And so now my inventory shows what? 194 is all that's left, right? Right? I sent him 100,000. It's an asset. I credited 100,000. I debit cost of goods sold, credit inventory, right? You know what? This guy has the nerve to send some of my stuff back. How dare he? Okay, so since he sends some of my stuff back that he doesn't want, he returns 30,000 worth of stuff that had a cost of 18,750. I'm not going to tell you how I calculated the 18,750. It is a reasonable using a profit margin as to how I would have come up with that 18,750. Don't worry about it. I'm just telling you the cost is what? 18,750 of what he sent back. So since he sent that back, if he sends it back, do I have a sale anymore? I don't have a sale anymore, so what am I going to do? And I don't have a receivable for that anymore. So I go ahead and I credit that 30,000 to my accounts receivable. I credit that 30,000 to my accounts receivable. So now it's 130, isn't it? It was 160. I just credited the receivable because he's not going to pay me for that 30,000 because he's sending me that stuff back. And I debit an account called sales returns. Now you're sitting there saying, but John, you said we don't have a sale. We should debit sales, shouldn't we? Well, we don't debit sales because we want to know how often people return our stuff. Why do we care? Why do we care how often we make a sale and then somebody returns it? Why do we care? See how good our product is, right? To know where to put our management emphasis, right? Maybe we've got the world's greatest sales team, but our production team is horrible and they're sending people junk like this. Send that back. What is that thing? Unplug it before it attacks us, right? Okay, so what happens? We sit here and we're saying, well, we don't want that thing. We send it back. Well, now we know that our stuff got sent back. This is our stuff getting sent back to us. Maybe we need to improve our product, right? So we want to keep track of that. So rather than just debiting straight to sales, we go ahead and we do what? We debit to this account called sales returns so that we can keep track of that, right? So we're keeping track of how often our stuff comes back? Okay. Okay, good. And then, of course, we have to bring back the cost of that inventory. And we said in this problem that the inventory cost us $18,750. They're sending me that back, aren't they? So I'm going to put that back in my warehouse, and I'm going to put it back in my inventory account. So I'm going to debit my inventory account back for that 18,750. Where's my inventory account? Up here. I'm going to debit that back for 18,750 because that stuff just came back, and that brings the balance back up to 212,750, right? And since that stuff came back to me, it's not part of my cost of goods sold anymore, so I've credited my cost of goods sold to reduce that back, right? Okay. Okay, good. Now what happens? Now I go ahead and I start to get paid. So now this guy's going to pay me. He pays me within the discount period. He pays me within the discount period. Right here, I'm going to put blue on this to hopefully make it a little more prominent here. He's going to go ahead and pay me within the discount period, right? And so what happens? Since it was $130,000 he owed me, that was the original what? 160 minus the 30,000 worth that he sent back, right? So he owes me 130. 2% discount on that is 2,600. So you take 130,000 minus 2,600. That means that what? That means that I guess I don't know my colors very well. I guess if you mix yellow and blue together, it stays green. So what happens? You go ahead and he's going to pay me $127,600. That's because he took a $2,600 discount, didn't he? Right? And so what happens? My accounts receivable, I'm going to credit for the full 130. So if you look at accounts receivable now, where'd my accounts receivable go? If you look at my accounts receivable now, my accounts receivable got credited for the full 130. It's now down to 0, right? 160 original. We credited for 30 when he sent that stuff back. We credited for the full 130 when he paid me. I'm going to only receive how much cash? 127,400, but I'm fine with that because he paid me early, right? So I go ahead and I take out the full receivable, and I go ahead and I put in this 127,400 into the cash. So I'm back with some cash now because I sold that stuff. I sold it for 130, but he took the discount, so I only have 127,400. And then what? Then I have to debit this account called sales discounts taken 2,600 to make the journal entry balance. And notice my sales discounts taken is going to be debited right there. Sales discounts taken. Why do I want to keep track of my sales discount taken? I mean, why don't I just debit sales? I want to know how frequently people take the discount, right? I mean, if I've got people falling all over each other to take this discount, maybe it's too good of a discount, and maybe I can reduce the discount and save myself a little money, right? Conversely, if I look in that account at the end of the year and it's 0, nobody's taking my discount, so maybe I need to make that discount a little better if I want to reap the benefits of getting that cash a little earlier, right? Okay? With me so far? Okay, so let's go ahead then and let's prepare our income statement right here. Income statement right here, right? What do I have? I have my sales minus my, there's that 30,000 sales return. See the arrow pointing to sales return? Right? There's a 30,000 sales return less the $2,600 discount means my net sales are 127,400. Gross sales, the 160 originally that I sold, minus the 30 return, minus the cash discount, right? Gives me what? Gives me 127,400, gives me something called net sales. You have to know this term, guys. You're going to get a bunch of questions on the midterm. I don't know about a bunch, but enough to make it worth your while to know that sales minus what? Minus the discounts, minus the sales return equals what, everybody? Net sales. Good. That's my net sales. Okay? So I have my net sales, and then I subtract off of my net sales my cost of goods sold. What is my cost of goods sold? My cost of goods sold was what? Was the original amount that I recorded in my cost of goods sold. Where'd it go? Who took my cost of goods sold? Where'd they go? Cost of goods sold is right here, right? Right there? It was the original what? 100,000 less what? Less the amount that he sent back to me, right? Okay, so my cost of goods sold was originally 100,000, and the amount that he sent back to me means that my cost of goods sold is now what? 81,250. Because he sent 18,750 back to me, didn't he? And I credited my cost of goods sold for that. I debited the inventory. So there's my cost of goods sold is 81,250. That's 100,000 less the amount that he sent back to me. The difference between my net sales and my cost of goods sold is called gross profit. Two key terms that you're going to have to know for the rest of your life. Your fault, not mine. You decided to be a business major. You're going to have to know for the rest of your life, okay, that you have your what? You have your sales minus your what? Discounts minus your returns is what? Net sales. Net sales minus cost of goods sold is called what? Gross profit. You need to know that for the rest of your life. So that you walk into a business meeting, right? And you want to impress everybody. And you say, so what were our sales last week? Well, they were 160,000, sir. Well, was that net sales? Did we consider the sales discounts and the returns on that? Well, yes, sir, we certainly did. Net sales were $130,000. And what was the gross profit? Well, gross profit after we took out cost of goods sold was. See how impressive you sound when you say those things? Okay? All right, so you need to be able, you don't want to be the guy in the meeting that has to keep going, what is gross profit again? You don't want to be that guy. Pretty soon they're like, don't invite that guy to the meeting again. We're done. I don't mean you, the guy who didn't know, right? That would be me in that example. Pretty soon you're sitting there saying, how come I'm not part of the gang anymore? How come they don't invite me to the meetings? What's going on? Because I got tired of explaining gross profit to you. That's why. It's not you. It's that you don't know gross profit. Okay? All right, so they go ahead, and that's gross profit. Now, what happens? You come over here, and we're going to see that I set up rent expense here by debiting rent expense and crediting rent payable. There is nothing new here that we didn't learn in the first few chapters, chapter 1, 2, 3, where we sat there and learned about accruing rent expense, right? So we accrue our rent expense, and we go ahead and we debit the rent expense, we credit rent payable. We consider rent expense an operating expense. Operating expenses, guys, operating expenses are things that we incur in the normal course of business. We incur operating expenses in the normal course of business. In the normal course of business, we incur operating expenses. Can we run our business without rent? No. So who asked me if I was from Fremont? Are you from Fremont? You never been to Hayward? You have? Do you know how to speak Hayward? I'll teach you how to speak Hayward right now. Ready? What's your name again, sir? Huh? Kevin? Chevum? Chevum. Hey, Chevum, what's going on? Pretty good. That's Fremont. Okay, now if you want to make it up into Hayward, right? Well, say, hey, say it to me. What's going on? Ain't nothing going on but the rent. Okay? All right, so, I think I lost contact with this thing and it wants to turn off now on me. What happened to this? See, I started to have fun and tell jokes and the whole thing crashes on me. What's the problem here? What's wrong with this thing? Are we still running? Yeah, we're still running. I don't know why it did that, but okay, we're good. Okay, ain't nothing going on but the rent. Okay, so what happens? You don't have a business if you don't pay your rent, right? You gotta pay your rent, okay? Nothing's going on. The rent always goes on. That's a normal course of business item, right? Now notice down here that I also go ahead and I accrue what? I accrue some interest expense, don't I? Remember, I have to accrue interest expense at the end of the year. Remember, we took the amount that we borrowed times the interest rate times however many months that was outstanding, whatever. Remember that whole thing? So we accrue interest expense. Interest expense is classic example of a non-operating item. These are not normal course of business. These are not normal course of business. They call them non-operating. What happens? Interest is not considered a normal course of business item unless you are a bank. If you are a bank, then interest would be normal course of business because banks make and pay interest on a daily basis depending on what's going on with them at any point in time, right? Guys, don't try and hide it from me. I tell you, I know when you're not looking at accounting information because I see the happiness on your face. You can't hide it from me. Don't even try. I know you're not looking at accounting. Okay? Don't come here to look at other things. What's the point? Okay? So what happens? You sit there, and if you're not a bank, interest is not the normal course of business because you don't necessarily have to incur interest every single day in a retail inventory, in a retail company that sells inventory. In a bank, every single day a bank goes out on the market, they loan money, they buy things, they try to get interest revenue, etc., right? So if this was a bank, interest would be what? Would be considered operating. If you're not a bank, you are what? You're going to treat interest as non-operating. In this class, interest, and I'll explain one other a little bit later, are going to be considered non-operating. But anytime something happens outside the normal course of business, we put it down in the non-operating section. And we do this because investors want to say, okay, I see. In your everyday normal course of business, you have sales, you got a little returns and some discounts. Okay, your net sales, less your cost of goods sold. I see your gross profit based on the stuff that you sell. But of course, we know you have to operate. You have to have a building to operate out of. So we see that that's going to continue in your normal operations. This is what your operating income was. And then we see that you did something that was a little different for you, not in the normal course of business. So we're going to see those expenses separately. We call them non-operating. We have our operating income minus our non-operating items gives us what? Gives us net income. We call this a classified balance sheet. Income statement. Okay. Okay, good. Speaking of the the balance sheet, there it is. Just pulling all our accounts down. There's our cash. There's our inventory. Those are our assets minus our liability, the rent payable, the interest payable, stockholders' equity. Remember the common stock? Plus if I just started my business operation and we did a bunch of these questions on the midterm, beginning retained earnings was 0, add in our net income, we didn't pay any dividends, so our retained earning balance is exactly our net income for this first year, right? 30,000. Does the balance sheet balance? Does the balance sheet balance? Always will. Okay. Question? Okay, guys, so what you're going to do with this thing, this mess, geez, is you're going to go ahead, now after we've gone through the whole thing, I highly, 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 highly recommend that you watch this whole thing again. What are we talking about here at this point? 32 minutes? Good investment of your time is 32 minutes to go back through this whole thing again. Before you work any homework questions, you should work these, and then you should work these again. When I say homework questions, I mean questions from the quiz, the quiz for this chapter. Okay? Okay, so we still got some time. Good. So what I want to do is go through the slides for Chapter 4. There are a couple of additional things that we're going to look at here. Then we're going to get out of here. And my recommendation is going to be that you look at this example for homework, and then you work the quiz questions for homework, and we'll pick those up next time once you've had a chance to look at them. Okay, but let's just go ahead and let's take a look at a couple of the slides here. And let me put it on slideshow. Okay, and let me find my little clicker here somewhere. I like how people just decide when to take the break. Like, okay, he's said all I need to know now, right? Meanwhile, for all he knows, I'm going to sit here and say, okay, ready? Answers on the next midterm. B, C, D, A, B. Okay. Okay. All right, so let's go ahead and let's take a look at the reminder here, guys, that what we're talking about are retail entities that sell merchandise. We're talking about retail entities that sell merchandise, probably Walmart being the biggest one ever. Okay, I mean, Rome didn't have a Walmart, right? I mean, you know, this is like the biggest thing ever, right? Okay. All right, so then we come over. I picked up the wrong one. I always have backups of everything, so okay, so here we go. Come on, you stupid thing. There it goes. Okay, now we have what? We have our sales revenue. Couldn't call it sales, call it revenue, less cost of goods sold equals what? Gross profit. We take off our operating expenses that are normal course of business. What do we end up with? Net income. We just looked at that, right? Okay. Okay, good. Now you come over, and when we talk about the flow of our costs, we have our beginning inventory. Our beginning inventory plus our purchases for the period give us what? Give us our goods available for sale. Beginning inventory plus whatever we purchase for the period. Okay, is going to give us our what? Aren't these the goods available for sale? Hello? I had beginning inventory. I bought some additional stuff. That gives me what's available for sale. If you walk into my store right after I purchase this stuff, you say, hey, what do you have available for sale? I say, well, I have my beginning inventory plus what I purchased. That's what's available for sale, right? Right? Okay. Now, they tell me that I'm either going to sell the things that are available for sale, and they'll go into my cost of goods sold. And if I don't sell them, they're still sitting here in what? Ending inventory, aren't they? Isn't that pretty much the options? Right? Okay. So, why is this useful to us? Well, think about it. If I'm sitting here and I have a problem on your exam, and I say, well, the beginning inventory was this, the purchases was that, you would be able to calculate the goods available for sale, wouldn't you? And then if I say to you, and the ending inventory was, why don't I put numbers on this thing? Makes it a little bit easier to understand. Beginning inventory was 100,000. Purchases were how much? 300,000. I'm just making this up. Goods available for sale is how much? 400,000, right? And if I tell you that there was 50,000 left in ending inventory, you should be able to say, well, that means, John, that your cost of goods sold is what? 350, right? Because if it's not here anymore, you must have sold it, right? You had beginning inventory, you had purchases, that's what's available. If it's still here in ending inventory, then you must have sold the rest, right? Right? Okay, so this thing is useful to you the way I'm putting it up here on the board. Beginning inventory plus my purchases. Can I fit it here without the screen flipping out on me? What do you think? Beginning inventory. How much is the beginning? Someone read my own numbers off here to me. How much? 100,000. Okay, good. And then I had purchases of how much? Of 300. That says purchases. So my goods available for sale are 400,000. Good. Minus what? Minus ending inventory. And if I'm sitting there and saying, well, I got 50,000 left, that means I must have sold 350,000 worth, right? Hello? Now they call it cost of goods sold. They could also call it cost of goods sold and stoled, couldn't they? Because what? It doesn't have to be that I sold it. It's not here anymore. Maybe somebody did one of these and they weren't doing a Michael Jackson tribute. They were sneaking out the back door with my inventory, right? Okay. You guys know who Michael Jackson is, right? Okay. So what happens is sit there. I have to always check. Sometimes I mention somebody who seems like every day to me, and students are going, who? Who? Michael who? Okay. So what happens? Some of that stuff may have been stolen. I'm just going to call it out as what? Cost of goods sold, right? Okay. So you have to know this formula right here, guys, that I put up on that slide that decided to change on me. You need to know that like a Catholic priest, don't you? So you ought to be able to rattle this thing off. Beginning inventory plus purchases equal goods available for sale minus ending inventory equals cost of goods sold. You can't sit there and go, I'm not sure what's what. Is this or is this that? You need to be able to do it because I may not ask you cost of goods sold. I could ask you what? Beginning inventory, and then you're going to have to work this thing up, aren't you? Or I could have asked you what were the goods available for sale by giving you some of the things lower down on the chart. Okay, so you need to know it like that. So it's good to think of your inventory in this way. Beginning plus your purchases give you the available for sale minus whatever's left equals cost of goods sold, right? Okay. Question? Okay. You were just doing one of these? Okay. Okay, good. All right. So you come over. And the accounting system that we just talked about, guys, is called a perpetual system. Perpetual system, we update our inventory records and our cost of goods sold after each purchase of inventory, after each sale. And isn't that what we did? When we bought the inventory, we debited the inventory. When we bought the inventory, we debited the inventory. We credited accounts payable, cash, whatever, right? When we sold the stuff, what did we do? We debited cost of goods sold and we credited the inventory. They call that a perpetual inventory system. That's called perpetual inventory system. That's what we'll talk about in this class. That's all we'll use in this class is the perpetual inventory system. Somewhat obsolete, guys, is the periodic inventory system. With the periodic inventory system, every time we purchase an item, we debit purchases and we credit cash, accounts payable, whatever. Notice we don't update the inventory account, right? And then what? When we sell something, we don't do anything with the inventory account. We only book the sale. We debit the accounts receivable. We credit the sales, and notice we don't do anything to the inventory account, right? So right now, if you think about it, our inventory account is only showing the goods available for sale in it, isn't it? It's showing what we had in beginning plus the purchases, right? So it's only showing, actually there's nothing in our inventory account. It's only showing what? It's only showing our beginning inventory at this point in time because we put that in purchases. So what we're going to do is we're going to sit there and we're going to take whatever was our beginning inventory and do what to it? Add what's in our purchases account. That'll tell us our goods available for sale, right? And then we will physically count the ending inventory. We'll go 3 pens, 2, 3, 4 computers, 5. We'll count up the inventory and see what we have left. And whatever we have left is what? Our ending inventory, isn't it? We subtract off our ending inventory, and does that yield our cost of goods sold? This is the way companies used to do it a long time ago when they didn't want to sit there and every time in their busy day-to-day business they received another shipment, they had to sit there and write down a bunch of accounting entries. They didn't do that. They just kept track of what? Here's my purchases. I know what my purchases are, and I can use my purchases as a vehicle to help me calculate my cost of goods sold, right? And I'll know what my inventory is by counting it. Why don't companies do this anymore as much, and why we're not going to emphasize it in this class? Why do companies not do this method as much anymore? Yeah, I guess you still got to count it at year end. Why do you still have to count it at year end? To find out how hard you're getting ripped off. Right? If you sit there and you say, okay, well, the thing says we've got 300 of inventory, I bet you there's only 50 out there because everyone noticed that you're not counting. And by everyone, I mean your employees are the ones that start to notice that you're not counting. And so what happens? You know, he never counts. Did you know he never counts? He never counts anything. You want this? Here, take it. He never counts, right? So what happens? You have to sit there and you have to count it periodically so that if something's missing, I say, well, wait a minute. You were the only one that had keys to the inventory locker room. What happened? And that's when everybody starts ratting each other out. Well, she talked me into the whole thing. It was her idea. I didn't know. Okay, so you have to count. So no, it's not the time spent in counting. What would be the other reason? Here's the hint. Because of what? Computerized system in the scanning, right? What do? As soon as something comes in, they go beep, beep, beep. They scan it all in, update the inventory records immediately, right? When they sell it, what do? Bloop, bloop, bloop. That's the stuff being sold. Bleep is being bought. Bloop is being sold. And what happens? They sell the thing, and it updates the inventory records immediately, doesn't it? I'm such an accountant. One time I went to a store and I'm like, how much is this? And they said, oh, well, we're not sure. That's okay. Just pay us this amount. No, 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 no. You have to update the accounting or the inventory will be off if you don't do that, right? No, find the tag for it, right? So what happens? You have to swipe everything to keep track of the inventory, right? Okay. Okay, good. But the most important part is that you know, well, two takeaways here. One, that you know that there's a perpetual system versus what? Versus a periodic system. And two, that you know this formula, right, that I've written down earlier on the other slide, so that you know how to figure out what the beginning inventory is, what the cost of goods sold is, etc., right? Question? Uh-huh. Depending on the materiality of it, okay? Like, if it's normal spoilage, then yes, we would go ahead and credit the inventory, debit the cost of goods sold for normal spoilage. If, the whole, freezer of hamburgers went frozen, went bad, because of a power outage or something stupid like that, then we would want to call that out as a separate line item on our financial statements, maybe call it casualty loss or something, and we would report that as a non-operating item. Because we are saying it's unusual, this is not the normal course of business, and we'll call it down as a non-operating. Okay, let's hope that doesn't happen, though. Or at least that we don't. Where did you work? 7-Eleven? Okay, good, thanks. I won't go there since stuff is spoiling. Huh? Huh? Don't buy it, thank you. You hear that, everyone? Don't buy anything over there. Okay. All right. Yes, sir.
Will you use this periodic system for companies that do services instead of goods?
Um, no. Services, why? No.
There's no
Because
inventory.
there is no inventory. You're thinking with service industry, we don't seem to think of them having a significant amount of inventory. I mean, what's the inventory in a service organization? Service organization, the revenue is generated off of service, right?
Correct.
So what's the inventory that you're thinking in a service organization? Yeah, so no, service organization, I mean, they could have small amounts of supplies, whatnot, but if a major component of their sales is going to be from selling inventory, we consider them retail.
Correct.
If they're service, then we consider them service. Now, that's not to say that you can't have both components. And if the sales get significant, I mean, excuse me, the merchandise sales get significant, we'd expect that they would use perpetual.
Right. I'm just saying because in this way you don't keep track of the inventory until the end of the year.
Yeah, I mean, you could do this with smaller items like supplies. In fact, when you think about it, that's really what we did with the supplies, didn't we? In our questions with the supplies when we were talking about service organizations, we said they started the year with this much supplies, they purchased this at the end of the year, there was only 13,000 left, and so we figured that they used 11,000 or whatever. That's pretty much what we were doing with that, right? But that was more supplies than actual things we're trying to market, merchandise, and sell. Okay. Okay, good. Let's just go ahead and we're going to skip by this because I already gave you the illustration. So I don't want to go back through another illustration that's less understandable than the one that I already gave you. But I do want you to look at these couple of things here. Actually, let me back up on that. They purchased inventory, they debit inventory, they credit accounts payable, right? We already seen how this works, right? With me so far? Okay. Okay, now what happens? We have a couple of terms that I want you to know. One is called free on board shipping point. The other is free on board destination. Okay, now what happens? With free onboard shipping point, what happens is the buyer pays the freight. Buyer pays the freight. Okay, we arranged for this guy to come and pick up this inventory from our seller and put it on that truck for us. We paid that guy. That's called free on board shipping point. Okay, now what happens? If that truck blows up on the way to us, the driver jumps out unharmed, but the goods are destroyed, who suffers the loss? The what? Buyer suffers the loss, right? So that inventory belongs to us as soon as it gets on the truck, doesn't it? So if the guy picks it up on December 31st, and it doesn't arrive at our store until January 2nd, should we include that in our ending inventory December 31st? Yes, we should, because what? It belonged to us as soon as it got on the truck, right? So with free onboard shipping point, you include it in ending inventory, even if you haven't constructively received it yet, right? How about the seller in that situation, free onboard shipping point? Did they have a sale as soon as it got on the truck? They had a sale as soon as it got on the truck, because if it blows up on the way, we're the ones that are going to suffer the loss, not the seller, right? So the seller would do what? Debit the account receivable, credit the sale, debit the cost of goods sold, credit the inventory on December 27th, even though the stuff doesn't show up, and I forgot what dates I said now, until January 2nd, whatever, right? That's free onboard shipping point. We pay the freight. Okay? Now, if we are dealing with free onboard destination, the seller pays the freight. And that title of those goods does not transfer to us until we take constructive receipt of it. So what happens? Stuff gets on the truck blows up on the way. Who suffers the loss? Seller suffers the loss at that point. That's considered free on board destination. If we ship the stuff on December 29th and it doesn't arrive until January 2nd, do we take that in our ending inventory at December 31st? It's not part of our ending inventory December 31st because we haven't received it yet, right? The seller does not have a sale, and the seller will not take that out of their inventory until the next year, until January, right? Now, this sounds like a bunch of nerdy stuff. Meanwhile, auditors are looking at this stuff constantly because companies will do little games. They'll sit there and say, well, the cost auditors are going to come and look at the inventory, so go ahead and ship a bunch of stuff around town and wait for them to leave, right? No, we're going to say, well, where is it? What were the shipping terms? And we're going to look at all that, aren't we? Okay. Yes. Depends on who pays the freight. Huh? Well, it depends on who arranges for that. I shouldn't say depends on who pays the freight, because you could pay the freight, but they arrange for the shipping. And if they arrange for the shipping, then the title won't transfer until you actually receive it, right? I mean, you're gonna want your money back if the thing blows up on the way, right? But so it really is a matter, even though in this class we'll say who paid, but it's kind of who arranged, even though you may pay it, okay? But it's who arranged, okay? Now, the most important part of this discussion, though, is how do we treat these fees that are paid by the seller versus the fees that for shipping versus the fees that are paid by the buyer, okay? And it turns out that if the buyer pays the shipping cost, we add that to the cost of the inventory. This buyer paid $150 shipping cost. They had paid what, $320 originally for this inventory, whatever it was. I don't care what the number was, $300, whatever. They add this shipping cost onto the cost of the inventory, don't they? Aren't they adding this shipping cost onto the cost of the inventory? Any cost that you pay to get an asset to you so that you can begin to use it productively in your business is part of the cost of that asset. Can we sell the inventory if it's still in our supplier's warehouse? Can Nordstrom sell you a shirt if it's still in the supplier's warehouse? Going to be difficult for them to do that. What happens? They have to get it to their store so you can hear the person playing the piano, so you'll play more for a shirt, right? Okay, so whatever they have to do to get it to their business so they can sell it to you is part of the cost of that asset, isn't it? Any cost that we pay to get an asset so we can use in our business is part of the cost of that asset. So since the free onboard shipping point, what happens? That means that the buyer pays the freight. We add it to the cost of the inventory, don't we? If the seller pays the freight, which is what we see down here in this bottom section of this slide, if the seller pays the freight, now it is considered an operating expense. It is called freight out. We call it freight out. Freight out is what type of expense? It's an operating expense. I don't know why this thing is delaying here, but it's called a what? It's called a operating expense. It is called an operating expense when who pays the freight? When the seller pays the freight. It is part of a normal course of business to pay the freight on something. What happens? You've been, well, you may not have been, you've maybe bought furniture before, right? And you're sitting there and you're saying, well, this is well, not this table. This is a nice table. I'd like to take it home, but man, I don't think so. I can't fit this in my truck. And the salesperson sees you over there going, go over there, quick, get that person before they leave. Tell them we deliver. And so what happens? They come over and say, oh, do you know we're deliver? We'll deliver. Completely changes your decision to buy that thing, doesn't it? Okay, so that is a selling expense. That's part of the normal course of business. That's part of the cost of doing business. So when the seller pays the freight, it is what? Operating expense. Okay, when the buyer pays the freight, it is part of what? Inventory. And by the way, guys, we call that freight. We call that freight in. Freight out, freight in. Freight out, that means that what? The seller is paying. It is an operating expense. Freight in, that means that the buyer is paying and it is part of the inventory. Okay? Okay. So we didn't have that example in our little example, right? So this is something that is a little different from that one example. Again, I'm pointing out things that were a little different from what we talked about in this set of slides. Okay? Not sure where my clicker went. What time is it? Oh, we still got time. You guys are starting to get spoiled. You're starting to wrap up. I see everyone wrapping up, and just look at the clock. Oh, that one's slow, huh? No, it's not slow. Okay, now, we know that purchase returns and what? Discounts come off of the cost of the sale. Okay, and then we have our what? Our terms 2, 10, net 30. This is the one you're going to have to know. These are other ways of calling out discounts. I'm just going to hold you accountable to 2, 10, net 30. How does this read? 2% discount if I pay in what? 10 days, and if I pay in 30 days, I have to pay the whole amount, right? That's right. Very good. Okay. Okay, good. Now you come over. I don't care about these examples because we already went through them in our little example. Okay. Oh, but let's track the. Okay, I'm lying to myself. I'm lying to you. Okay, let's go ahead and let's track this inventory. Okay, and this sale. Let's go through it. It won't hurt. Or this purchase of inventory. So we debit accounts payable for $3,500. We do what? Credit the cash, and we credit the inventory because we took a discount, didn't we? Right? And so if you take a look then at what happened if with this inventory, we originally purchased it for $3,800. We added in the freight in. We did what? We credited out the return. We credited out the discount. So the sale ends up showing what? I mean, the inventory ends up showing net of any returns and discounts plus the freight in, right? Okay, so if I give you a problem where I say, here's what they originally paid for the inventory, here's the returns, here's the discount terms, here's the delivery cost, you should be able to calculate the cost of that inventory, right? Okay. Okay, good. I'm going to go past some of these because it's more the same of what we already learned. Okay. Then what? We know that our net sales, or whatever our sales were, less the returns, less the discounts, right? Isn't that the net sales? Okay. Okay, good. Closing entries, you already know. I'm just reminding you of them here, right? You already know how to do the closing entries? Debit the revenues to close them, credit the expenses to close them. Difference goes to income summary. Income summary closes the retained earnings, right? Do we close the dividends into retained earnings? Yes, we do. This company had the dividends, so they go ahead and they close that to retained earnings as well, right? Okay. Okay, good. Two versions of the income statement, single step and multiple step. Whether you knew it or not, you already know the multiple step. Okay? Multiple step is what? We have our sales less our returns less our discounts gives us what? Net sales. Net sales minus cost of goods sold gives us what? Gross profit. Then what? Then we come over here and we take our operating expenses. Notice freight out is an operating expense. All of our day-to-day expenses, our utilities, our advertising, that gives us our total operating expenses. Our net sales minus our operating expenses gives us operating income. And then we take out our non-operating items, or add them, whichever we have. Interest revenue would be an add. Interest expense would be a subtract, wouldn't it? And that gives us our what? Net income. Okay. Now, we also have in here what? Gain on the disposal of a plant asset. Do you see that? Now, what's going on with that? Let's say I purchase an asset for $100,000. I would debit the equipment for $100,000, credit cash for $100,000. And if I look at my balance sheet, I have equipment of how much? $100,000, right? Now let's say that I start to depreciate this asset. And I depreciate it in year one, and I depreciate it in year one for $2,000. Who wants to give me the journal entry for that? Who wants to give me the journal entry for that? Debit depreciation expense for what? 2,000, and credit the accumulated depreciation for 2,000. Good. So at the end of year one, when I report the carrying value of that asset, it's going to be equipment of 100,000 less the accumulated depreciation of 2,000. That gives me a net carrying slash book value of this equipment of how much? Hello? 98,000, right? Right? Okay. Okay, good. Year two comes. It's depreciating $2,000 a year. What journal entry should I make in year two? What journal entry should I make in year two? I depreciated $2,000 a year. Same journal entry, debit depreciation expense, 2,000, credit accumulated depreciation, right? So now the accumulated depreciation has how much in it? 2,000 the first year, 2,000 the second year. It's got 4,000, doesn't it? Okay. So when I prepare my balance sheet now for year two, 4,000 carrying value of the equipment is how much? 96,000, isn't it? With me so far? Now someone comes by and looks at that piece of equipment and says, "Are you kidding me? You have an original San Jose State desk?" We say, "Yes, we do." "I'll buy it from you." "Well, we're using this in our business. I want this. I got to have it. Please, I'll give you 102,000 for this thing." We say, okay, since you're going to give me 102,000, I'll take it, right? And so what happens? I go ahead, and when he pays me, how much cash do I get? I don't know the best place to write this. I'll write it on the screen. When he pays me, how much cash do I get? 102,000. If I receive cash, should I debit cash or should I credit it? Debit. So I'm going to go ahead and I'm going to debit the cash. 102,000. How much is in the equipment account? How much is in the equipment account? 100,000. Good. You didn't use your imagination. Very good. We have 100,000 still in the equipment account, don't we? How much is in the accumulated depreciation account? 4,000 because I'm getting rid of this thing now, right? I should have done one more year. Let's say I do one more year. So let's say the accumulated depreciation account has how much in it? $6,000. So I'm sitting here and I have what? 100 and no, I was right the first time. What am I thinking? 4,000. That was okay. So I sit here and I have 106,000 of debits, don't I? I got rid of the equipment. I got rid of the accumulated depreciation. What do I make to make this journal entry balance? What do I need to make this journal entry balance? A debit or a credit? I need a credit of $6,000, don't I? To make it balance. So what I credit is something called gain on sale of equipment. Didn't I gain there? Because I had equipment that I was carrying for 96,000 and I sold it for 102, so I gained 6,000, didn't I? Right? And so what happens? I report that gain, and I would report that gain off. I should have made it. If this was 6,000, you would weep at what a beautiful example that was. I wanted that to end up I thought there was 6,000 there, but I wanted it to end up whatever was showing there. But that gain is what? Shown down in the non-operating section of the income statement because I'm not in the business of what? Of selling my equipment. That's considered non-operating, right? My business is, teaching classes, whatever, with this podium, and I just sold this. This is not my normal course of business, right? So I would go ahead and do what? I'd report that as a gain. And I wanted it to end up to be 6,000. It was 600, but otherwise it would have worked perfect, right? Okay. Now that is considered the multiple step. Notice we have net income of how much? 31,600. See that? Okay. Now if you go over to the single step, notice the net income's exactly the same, isn't it? 31,600. Okay, but what changes is how we present the items. And what we did is we put all of the revenues and gains, all the things that increase my net income, into one big chunk. And then we took all the minuses, the things that decrease my net income, and put them into one big chunk, didn't we? But the net income turned out the same. Okay, so I don't know why they don't call it the two-step. 1, 2, revenues minus expenses. I guess they don't because they were afraid the country western people would get mad at them if they called it the two-step. Okay, so they call it the single step. Okay, but if you look at it, it's what? Still giving you the same net income, isn't it? Okay. Okay, good. We will pick up here next time, guys, but there is no reason at this point that you shouldn't be able to get into the Chapter 4 quiz questions, and I may call on some of you to help me with those. So be ready to go through the Chapter 4 quiz next time. If you know somebody who's decided to check out of the class, I'd let them know sooner than later that they're going to start to pay the price. Okay, see you. Have a good one. Congratulations. Yeah, was it due? Oh, yeah, I'll still take it. Yeah. What was that, the career development project thing? Yeah. Sooner the better, but no, not really. Just don't give it to me like the last day or something, but yeah. Yeah, if you get it, I'll get it to you. Okay. I'm sorry. Go ahead.
Can you just sign my major paycheck? I got it from Candace.
Okay, sure. Right here? Okay. Did you pick up your Scantron?
Yeah, I already did.
Okay. Okay. Great. Thank you. Uh,
I just have a quick question.
yeah.
How come we don't always just use a single step? It's so much easier.
Because the users of the financial statements would prefer the multiple step. And remember, we do everything for the users of the financial statements. So single step is really just a quick and dirty thing that we would use for very informal purposes. Okay, but if we're issuing financial statements, with the stock exchanges and that, we should be using the multiple step. There's an expectation that we would use the multiple step for
That's
that.
probably where we're going to be focusing on.
Yes. Yes. Yes, sir. Yep.